Okay, let's get to Archegos. The firm behind the 30 billion fire sale shaking financial markets disclosed almost nothing. As yesterday was when the story broke and everyone found out about Archegos, which nobody even knew what Archegos was really. And I'll explain that in a second. It talks about this in this article and some other articles. Up until recently, the website of Archegos Capital Management, the firm behind a reported $30 billion financial fire sale that is battering stocks worldwide, contained a giant image of Central Park. The vista displayed on Archegos' webpage was a fitting homage to the views of its offices atop a Manhattan skyscraper on 57th Street. Until the site was taken down as the firm gets liquidated. Liquidated for $80 billion. Good. This is being called the biggest margin call ever in history. It just blows my mind and everyone else's mind, because how can this be the biggest margin call in history? But nobody even knew about it. Nobody even knew what Archegos was or how much they owned and what they were doing. And then it just blows up, and then it's like, oh, we can't let this ever happen again. Like, it should have been caught in the first place. Okay, Archegos was a giant in the U.S. financial markets, apparently holding tens of billions of dollars in securities, including massive exposures to companies like Viacom, CBS, Discovery Communications, and Baidu. We saw this yesterday. All of them tanked bigly. All got wrecked, but they were recovering today. It traded with Wall Street's largest brokerages and was headquartered at an expensive address, housing many powerhouse investment firms. But when it came to the routine financial disclosures, Archegos was virtually non-existent. Forbes searched for a trace of Archegos on the Securities and Exchange Commission's repository for securities filings called EDGAR, short for Electronic Data Gathering, Analysis, and Retrieval. Amazingly, almost nothing came up. So it's a phantom company. It's a ghost company. Nobody even knew they existed. Except the hedge funds, because they were doing business with them. Why did nobody know about this? Well, you know what? Let's talk about some background about this guy, Bill Wong, the owner of Archegos, the CEO, the founder and CEO of Archegos. Educated in the U.S., Wong made a name for himself in the 1990s and early 2000s at Julian Robertson's famous hedge fund Tiger Management. After building a resume at Tiger, he broke off and founded his own hedge fund called Tiger Asia in 2001, reportedly with backing from Robertson. Wong's firm was a tiger cub, a term insiders used to describe dozens of hedge funds with DNA traces to Robertson's legendary firm. Tiger Asia became one of the largest investors in Asian financial markets, managing billions of dollars in assets at its peak. Then it all came crashing down. In 2012, the Securities and Exchange Commission brought an insider trading and market manipulation case against Wong and his Tiger Asia. The firm and its founder agreed to pay $44 million in fines and penalties. Tiger Asia Management, the management company, admitted to breaking the law. The SEC's probe effectively put Tiger Asia out of business. This guy is crooked. 9 years ago, this guy was caught for insider trading, and his company got fined $44 million. I don't know if it says here, but the SEC also barred him from opening another hedge fund. He's banned for life from opening a hedge fund. So what did he do? Right here. In 2013, Wong converted the firm into a family office set up to manage his private wealth. The family office, Archegos Capital Management, appears to be massive, not just in scope and size, but also in risk appetite. However, its status as a family office exempts it from the Securities and Exchange Commission's reporting requirements for investment firms. So this is how he got away with not reporting anything to the SEC, and nobody knew they existed because his hedge fund was classified as a family office. Even though it's controlling billions of dollars. Yeah, family office, right? Archegos appears to have built its positioning almost exclusively through swap trades and its relationship to a handful of brokerages. Wong's outfit leaned heavily on swaps to build its positions in companies like Viacom CBS. Swaps are an effective tool to take big risks without disclosing much. Total return swaps, for instance, allow an investor to negotiate a trade with their broker to own the total return of a stock or basket of stocks for a predetermined size and period of time at an agreed cost. They require a fraction of the cash of buying a stock outright, and they're discrete. Swaps aren't included in the SEC's 13F reporting's requirements. Thus, Wong's monster portfolio was mostly hidden from plain sight. It appears that they gained most of it, if not all of it, of their exposure to the various securities through swap arrangements, says Robert Williams, an expert on matters of tax and securities law. This guy, crooked guy, got caught for insider trading, got fined $44 million, got banned from owning a hedge fund for life. So he opens a family business, and he's hiding all of his trades through these swaps, return swaps. People have been saying on Wall Street Bets like these hedge funds are hiding their positions. I didn't know to believe it or not and like how true it is, but a lot of people are claiming that hedge funds are using these dirty tricks where they can do things like this and buy swaps, and it's not going to show up on official data, like short interest. Yeah, so Morgan Stanley, Credit Suisse, Nomura, UBS, Goldman Sachs, massive shareholders. They all took some fat L's. Bloomberg reported that Goldman Sachs was uncomfortable working with Wong after his SEC troubles, but ultimately relented when the business went to competitors across the street. Now the shareholders of Goldman Sachs, Morgan Stanley, and other brokerages will await any details on losses suffered by the mysterious client. So Goldman Sachs was like, red flags, I don't think this is a good investment, but all their competitors, Morgan Stanley, Credit Suisse, Nomura, they were rolling in the tendies for a while. So Goldman Sachs just couldn't resist, and they ended up taking an L. Goldman Sachs increased its position 54% in January. I'm sure there are a number of really unhappy investors who have bought those names over the last couple of weeks and now regret it. Doug Sifu, CEO of electronic trading firm Virtu Financial, said Monday in an interview on Bloomberg TV. He predicted regulators will examine whether there should be more transparency and disclosure by a family office. You think? So, I'm curious, why didn't more people do this? Is this guy just a genius and he figured out a loophole? Wong is a trustee of the Fuller Theology Seminary and co-founder of the Grace and Mercy Foundation, whose mission is to serve the poor and oppressed. Really? The foundation had assets approaching $500 million at the end of 2018. He says it's not all about the money, you know, he said in a rare interview with a Fuller Institute executive in 2018, in which he spoke about his calling as an investor and his Christian faith. It's about the long term, and God certainly has a long-term view. Well, that didn't age well, right? It's not all about money, but you're going to 5 times leverage on your $16 billion. Like, why do you even need to do that? You have $16 billion. He could have just not taken any margin, no leverage, and he's good. No. Now this is the biggest gut in history. Credit Suisse may lose $3 billion on Greensill. More hedge funds taking losses. The Swiss bank's hit from a troubled range of supply chain funds may eclipse its net profit last year. Credit Suisse's board is scrambling to ascertain the wreckage and reportedly thinking of compensating clients for some damages. Not a good week for Credit Suisse. Possible $3 billion loss on Greensill. And if you recall yesterday, right? My show yesterday, I showed this. Credit Suisse exits positions with a U.S. hedge fund warns of significant losses. I believe this was $2 billion in losses, Really, really bad week for Credit Suisse and others. Do you feel bad? I don't feel bad. Thanks for tuning in, guys. Great show today. Please like the video. Like the video and subscribe. And share with your friends, please. I'd appreciate that. If you want to support, check out my Patreon. I'm Ty. This has been Smarter Gambling. I see you tomorrow. Peace.